All right, class, we're on to our second lecture, which, again, I just emailed you guys and have let you guys know that things are going to start running a lot more smoother. Some technical difficulties had arose, but we are now set to go. So what I'm going to ask you to do for this second lecture is, hang on one second. All right. What I'm going to ask you to do for the second lecture is I want you to go ahead and open up the part 2 lecture. Now, this is important because this is the beginning and the real start of the information that we're going to need for this semester. So this is going to be the most important lecture because everything that you're going to hear and learn at this point is literally going to be stuff that you should know anytime you are working in accounting. Whether it's a 100 level course or a 500 level course or any course like that, this information that you're going to start hearing and looking at is going to be needed to be known. So if you open up the part 2, chapter 1 slides, the very first slide you're going to see it says types of accounts. Now we're going to reference types of accounts so many times that you're going to get sick and tired of me asking you questions or asking you to tell me what account is what. The first thing I want to talk about is, as you can see on the left-hand side, I'm going to give you acronyms as much as I possibly can to try to get you guys to remember these things. These are things that you're going to have to remember, so these are things that I need you to pay close attention to. The first acronym that you're going to learn in this class, it's called ALSDRE. And as you can see, ALSDRE is written there on the left-hand side of your page. It's ALSDRE. Now, every transaction in the business world has to be recorded. That's what accounting is all about, is recording transactions so that we can use them for later on and useful purposes. So ALSDRE, the standing for ALSDRE, the A stands for what we call an asset. L, you can see, is the liability. S for stockholders' equity. D for dividends. R for revenue. And last but not least, E for expenses. Okay? Now, those are our main categories. And each one of those gets placed on a financial statement that we are going to be preparing later on this next week. So the first thing I want to do is I want to talk about each one of these individually. So when we say ALSDRE, this is what I want you to pay attention to. I want you to think of ALSDRE: assets, liabilities, stockholders' equity, dividends, revenue, and expenses. Try to get in the habit of doing them in that order. There's a reason that we have it listed as ALSDRE, and you'll understand more of why we do the order in a minute. Okay? So just understand assets, liabilities, stockholders' equity, dividends, revenue, and expenses. Moving on to your second slide. Here's where we have ALSDRE broken down so that you get some definitions for each one of them. And the other thing that we're going to do is we're going to start giving you examples of each one of these accounts. So if you take a look down the middle in this column, you'll see the account type. The very first account type that we have listed there is assets. Like I told you, we're going to go down in the same order all the time. We're going to say ALSDRE. So first one that we have listed there is what we call our assets. Now, before you even look at what type of assets there are, I want you to look at the definition of an asset. And the definition of an asset is something that you own that has a future benefit. Okay? If you've got a lot of cash, which is the number one asset you could have, is that a good thing or a bad thing? All right. Take a look at some of the other types of accounts that are listed as assets. We've got accounts receivable. That's the blank. Okay. So that's going to be accounts receivable. Supplies, equipment, if you own land, if you own a building, even if you have stocks and bonds like investments, those are all things that have a benefit to you. Now, just keep in mind, the number one asset you could possibly have, no matter what, hands down, is cash. When it comes to accounting, cash is the measurement that we use to value everything. So cash is, you've heard the expression, cash is king. Well, in accounting, yes, cash is actually king. Okay? So please keep that in mind. Now, next one we have is what we call a liability. Well, before I go on to liabilities, I want you to take a minute real quick and think about assets that you have. Do you have a computer? That's an asset. Do you have a cell phone? That can technically be an asset. Do you have cash in your pocket? That's an asset. Does your roommate owe you $20 for grabbing you something from the store the other day? Yes, that's an asset. The fact that somebody owes you money is technically an asset. Okay? If you owe somebody money, that's a liability. But if somebody owes you, that's a good thing, because that means somebody's got to give you money in the future, which is a future benefit. Okay? Supplies, even such as like notebooks. Depending on what type of business you're in, having a supply of notebooks is an asset, because that may be what you sell. So if that is what you sell, that could be an asset. So I just want you to take that moment and really think about some of the assets you may have. Okay? Moving on to liability. Whenever you see the word payable, okay, whether it says bonds payable, income tax payable, salaries payable, rent payable, anything with the word payable, I want you to automatically associate that with it being a liability. Okay, a liability is money that you owe. Okay, if you take a car loan out, you have a car, a car payment payable, mortgage payable, interest payable. Normally, the main account that we're going to use when it comes to payable for financial is what we call accounts payable. So let's say you are a big business and you ordered supplies from a store. You got your supplies, but you haven't paid them yet. So you have an accounts payable, because you have to pay that store for the supplies later on. So the main one I want you to think about, and for what we're doing with financial accounting, is just think of accounts payable. Okay? But keep in mind, if you see the word payable, that is automatically going to be a liability. That means something that you owe. Okay? The next one is stockholders' equity. Now, I'm not really going to go into a definition of stockholders' equity. I do want you to know that there are two components to stockholders' equity. There's the first one, which is what we call common stock. It can also be called contributed capital at some points. Okay, so common stock or contributed capital are the same thing. And then the second one is what we call retained earnings. Okay, retained earnings. And simply stated, these are claims by the owners to the business. Okay, I won't ask you what the definition of it is, just it's there, where to find it. But I will need you to know what are the two components of stockholders' equity. And those two components, again, are what's listed on the left. That's common stock, or it could also be called contributed capital. And then the other one is retained earnings. All right. Moving on to the D in ALSDRE. It's dividends. Now, if any of you own stocks, your stocks that you own may pay a dividend. The key with dividends is the account's exactly the same thing. It's called dividends, so there's nothing to really memorize here. What a dividend is when a company makes money. Even the company doesn't really necessarily have to make money. It's distributions or money given from the company to its investors. Okay? When you get out of college and you're making six figures, which is what I hope every single one of you guys are all doing, you'll start a 401k or a retirement or a Roth IRA or something like that. And if you own stocks, one thing they tell you is if you buy dividend stocks, reinvest your dividends. Okay? Dividends are payments from companies to stockholders. They don't necessarily have to be making money to pay a dividend. Right now, Exxon's running pretty poorly. It's not making as much money as they used to, and they're still paying the dividend they did from when they were in their heyday. Well, because they're giving cash away. They're giving some of their cash reserves back to their investors. It's not the greatest thing, but dividends are good if you own the stock, because you're going to be making money. All right. Next one is what we call revenues. Now, revenues has different types of things that you could call a revenue account. And what I mean by that is if you own a golf course, okay, when you go play golf, the golf course charges you a greens fee to play on their golf course. So that would be a particular revenue account for a golf course. A grocery store is not going to use green fees as a revenue account title. Okay, so each individual type of business that you have is going to have a different account name for the revenue. Now, revenue is just simply earnings from what you do in your business. So, for instance, McDonald's, their business is selling hamburgers or selling food. So they would have sales. The grocery store has sales. If you owned a nail salon, okay, you would be charging money for your nails being done. So you would make your revenue account something associated with those that topic. Okay. Some of the keywords to look for to find your revenue accounts are like things with the word earned or revenue or sales. You can even be as blatantly, generic as the word sales. When you do get into certain specialty company businesses, you can get a little bit more in depth because a company may, for instance, we'll go back to the golf course example. The golf course is going to charge you to play on their course, so that's going to be what they call green fees. But then they may also charge you an additional fee to rent the golf cart. So they'll charge you green fees and then the golf cart rental fee. Okay? So again, every company can have more than one revenue account. It's not unheard of, but for what we're going to be doing in this class, the companies are only going to have one revenue account. Part of the problem that you guys are going to have and that you have to learn to go through is you've got to be able to look at a list of accounts and be able to pick out your revenue accounts or revenue account. All right. All these things I'm going to show you when we get to problems are what's the easiest way to go about doing it. And I will explain that when we get to those problems. The last part of algebra is the word expenses. Now you can see that on the left-hand side, we have a blank and then we have the word expense. Okay. You could put every different type of expense. There's multiple different types of expenses. You could have rent expense. You could have cell phone expense. You could have computer expense. You can have supplies expense. You can have auto expense. You could have income tax expense. You could have salaries expense. All the different types of things that a company goes through. And what will happen is every transaction that you come across, you'll have to classify the accounts that you need into these types of accounts. We'll get into that later on in this chapter. But each one of those you'll use and you'll make up them. Some of them will be given to you. Some of them may be in the narrative of the question. So do not get yourself all concerned about, I can't figure it out. It's easy. Okay? I will tell you everything you need to know in these videos. The biggest problem you're going to have is if you don't listen to the videos. That's going to be your biggest problem. Okay, so when I give you these lectures, keep in mind, normally if we were sitting in class, you'd be listening to me for an hour and 15 minutes twice a week. I'm condensing these down and trying to get you guys as much information as I possibly can and try to shorten the videos to about 30 minutes apiece so that this way I can kind of give you guys a little bit of time to go out, get yourself a drink. If you smoke cigarettes, go out and have a cigarette, or if you're whatever you're doing. This way you're not sitting there for an hour and 15 minutes bleeding out of your eyelids listening to me or out of your ears listening to me. So please keep that in mind. This slide is extremely important because, again, we talk about the algebra. It does give you examples and it does give you the definitions. Now, the next 5 or 6 slides that we go through are going to be exactly the same thing. So I'm going to kind of push through these next 5 or 6 slides so that I can move on to the next topic. And I can set you guys up with a homework assignment that's going to be coming up here also. So just hang on with me here, and we're going to move down to slide number 3, okay, moving on to slide number 3. Actually, we're going to go into financial statements first. Slide number 3 talks about those financial statements I mentioned in the first lecture on September 8th there. So after all the transactions, which you guys have no idea what they are summarized, we are going to start making financial statements. Okay, these are important. There's 3 financial statements that we are going to make. I know that there's 4 listed on slide 4, so go ahead and move to slide 4. I know there are 4 financial statements listed on here. In financial accounting, we're only responsible for learning 3 of them. The last one, which you see at the bottom of this slide, is statement of cash flows, is held off and taught in managerial accounting. Okay? So the 3 that we need to be most concerned with, or 100% concerned with. The first one is what we call our income statement. And that is how we figure out whether a company lost or made money. It's also called the profit or loss statement. Okay. Now, the second statement is what we call the retained earnings statement. And last but not least, we call the balance sheet or the statement of financial position. Whenever you guys go out to get a loan, most of the time, the bank will ask you for a personal balance sheet where you list how much you have in assets, how much money you owe, which would be your liabilities, things like that. It's pretty much the same thing for a business. These are all things that outside users like the IRS, investors, people on Wall Street, these are the financial statements that they look at and base their financial decisions off of. So these are very important, not only for the sake of the company, because if you need to get money from investors, you need to have a good balance sheet, you need to have a good income statement. And if you don't, then you're probably not going to get as much money as you need to complete or do whatever you're looking to do with that money. All right. So the three that we're concerned with is the income statement, the retained earnings, and the balance sheet. Now, if you move to slide 5 here, I want you to see, this is another important slide, as most of these are all going to be important. So I'm going to be kind of being repetitive when I say that. Here's where the ALSDRE comes into play. And ALSDRE is going to come into play with everything we do pretty much in financial. So whatever you do, please do not disregard how important that very first slide in this slideshow is. It is extremely important. It's what we base most of this whole course off of. And it is the building blocks of all of accounting. So keep that in mind. Now, we just went over the financial statements, which were the 3 income statements, statement of retained earnings, and the balance sheet. Now, if you're looking at slide number 5, this is key for you to keep in mind. Number 1, when we prepare the financial statements, we have to do them in a particular order. Okay, they have to go in order because each one of the statements needs a number from the prior statement. So the very first statement that you would prepare, if we were doing financial statements right now, you would see from this slide, it tells you that we're going to start off with our income statement. On that income statement, there are only 2 types of accounts listed on the income statement. Okay, and that's revenue and expenses. So on your income statement, you shouldn't have any assets, any liabilities, no dividends, no nothing. None of those should be on your income statement. And this is why it's important for you to be able to classify what accounts are. For instance, you should be able to tell me that cash is an asset. So if you know that cash is an asset, taking a look at this slide, what financial statement should you find cash on? Well, if you're looking at this slide, you should say to yourself, well, cash should be on the balance sheet because it is an asset. All right. If you've got rent expense, well, expenses are listed on your income statement. So the key here that I need you guys to understand is why ALSDRE is so important and why it's important to classify each one of these accounts to its proper classification. If you prepare a financial statement that has the wrong numbers, you're going to misrepresent the business, and that's not a good thing. Okay, so the first thing, income statement, has your revenue and expenses. The next statement, which is your statement of retained earnings, has your dividends. And then the very last statement that you're going to be preparing is what we call our balance sheet. And the types of accounts that you see on your balance sheet are simply going to be your assets, liabilities, and stockholders' equity. Those are the 3 types of accounts that will be listed on your balance sheet. Does everybody understand that? We have to start from the bottom up. Okay, it's important that we go from the income statement to the statement of retained earnings, and then last but not least to our balance sheet. All right, so moving on to slide number 6. Actually, I'm going to stop there and stop this video so that I can go ahead and get this uploading for you. So what I'm going to do is I'm going to stop there and I'm going to start another one and just stay with me. All right.